So far, we have looked at a portfolio that involves a single risky asset and a risk-free asset. We looked at them individually. Which does an investor prefer, the risky asset or the risk-free asset? Then we said, let's combine the risky asset with the risk-free asset, put 60% of our money into the risky asset, 40% of our money into the risk-free asset, and see if the investor prefers that portfolio. Then we said, let's change around that percentage and see what is the optimal percentage that goes into the risky asset and the risk-free asset. And of course, when you change it around, you get the capital allocation line, and we ended up using Solver to find for the optimal percentage that goes into the risky asset and the risk-free asset. What we're going to do now is we're going to introduce a second risky asset. We're going to take away the risk-free asset, but don't worry, we'll bring it back. So right now, we're going to take a look at what happens when you have two risky assets, just to kind of let you know where we're going with this, okay? We started out with one risky asset and risk-free. Now we're going to have two risky assets. Then we're going to have two risky assets and a risk-free asset. Then we're going to have three risky assets. Then we're going to have three risky assets and a risk-free asset. Then we'll have five risky assets. Then we'll have 8 risky assets. And then we're going to end up with hundreds of risky assets. So that's kind of where we're going. And so it's a progression in terms of where we're going on this thing. All right, so what we want to do is we want to take a look at an Excel spreadsheet that is available for you that I think in the title says two risky assets. So let me bring that up for you here. I think it's titled Two Risky Assets and No Risk-Free Asset. So here is that Excel spreadsheet, right? And we're not going to be using Solver on this, at least not right now. We will be later on, I think. But what we have right here is the data that is being entered to begin with is right up in here, okay, starting with cell B4. And so we have two risky assets, which we title X and Y. The expected return on X is 10%. The expected return on Y is 20%. The standard deviation of X is 7%. The standard deviation of Y is 10%. The variance of X is going to be the standard deviation squared, right? The variance of Y is going to be its standard deviation squared. The correlation between X and Y, we know can be as high as 1, as low as -1. We're going to be changing this around, okay? But at a correlation of 1, they're perfectly positively correlated. They move exactly perfectly up and down together. Now, you'll never find two naturally occurring assets that do this, but we're going to start out with X and Y being perfectly positively correlated. Then the covariance between X and Y, we've talked about this before. The covariance is going to be the correlation between X and Y multiplied by the standard deviation of X times the standard deviation of Y. It also measures how much they move up and down together or versus opposite each other, but it's not bound between any two numbers. So I couldn't look at that at 0.007 and know that they're perfectly positively correlated, but I can look at the correlation of 1 and know that they're perfectly positively correlated. Then what we have here is we have different weights of X, okay, going from 0 to 100. So we don't have any negative weightings here. We will later on, okay, but we don't have right now any negative weightings on X. And of course, the weighting on Y is always going to be 1 minus the weighting on X. So if we change the weighting on X, it will change automatically the weighting on Y. Then under expected return, what we have is we have the equation for the expected return on portfolio. It's going to be the weight on X times the expected return for X plus the weight on Y times the expected return on Y. Okay, in every single case, that's going to give us the expected return for a portfolio. Now, for the standard deviation of the portfolio, it's going to be the square root of the variance. Okay, let me bring this down. It's the square root of the variance. So what is the variance? It's going to be the addition of the cells in a weighted variance covariance matrix. There are two assets, X and Y. So there are going to be 4 cells in the weighted variance covariance matrix. So we're going to have the weight on X squared times the variance of X. That's 1 cell, plus the weight on Y squared times the variance of Y. That's the bottom right-hand cell, plus 2 times, because we got those two twins, okay, upper right-hand cell and lower left-hand cell, which is going to be the weight on X times the weight on Y times the covariance between X and Y. So that's adding the 4 cells up. And then we take the square, which gives us the variance of the portfolio, take the square root of that, and that gives us the standard deviation of the portfolio. Okay, so it's stuff we've learned already that's going to give us the standard deviations of each of these. Now, what you'll notice here in the graph is just simply reading the information that is over there. Now, for right now, just ignore this line right there. X is going to be right down at the end of that line. That's going to be where we have an expected return of 10%, standard deviation of 7%. That is going to be where X is in mean variance space. Whereas Y, it's got an expected return of 20% and a standard deviation of 10%, again, right at the end of the line. Now this line, okay, it's not the capital allocation line, because the capital allocation line, remember, starts at the risk-free asset. We call this line the opportunity set. It's the opportunity set because you have an opportunity to be anywhere you want to be on this line by putting some of your money in X and some of your money in Y. Remember, you as the portfolio managers, as the coach of your team, get to decide what is the weighting on X and what is the weighting on Y. So what we find, and we can take a look at this over here, if I put all my money on Y, okay, then I'm of course going to be up here where I have an expected return of 20%, standard deviation of 10%, okay? If I put, let's say, 50% of my money in X and 50% of my money in Y, I'm going to be right here where I've got an expected return of 15% and a standard deviation of 8.5%. And if I go down here where I put all my money into X, I have an expected return of 10% and a standard deviation of 7%. So this is plotting, okay, all this. Now, what you notice is it's a straight line, okay? That is going to be the case because X and Y are perfectly positively correlated. We get no benefit of diversification when X and Y move exactly together all the time. And then it doesn't, we don't get any help from diversification. Remember, the help we get from diversification in lowering standard deviation is that when one asset is down, the other asset might be up, or at least not down as far, and that creates a less standard deviation for the portfolio. But you only get that if the assets don't move perfectly up and down together. Here, right now, they do. So let's change the correlation between X and Y. Now, in reality, you can't just say, I want the correlation. I want to change the correlation between, between Goldman Sachs and Apple, okay? I mean, the correlation is what it is, okay? But we're using hypothetical, examples here, X and Y. Okay, so we're going to change the correlation. Instead of being 1, we're going to make it 0.5. So I'm going to plug in 0.5 here and hit enter. And when I do that, you see we no longer have a straight line. We have a curved line. In fact, it has a specific geometric shape, and that is a hyperbola. If you don't see it now, you will see it later on, but this is a hyperbola here that we've got. And what we also saw happening was that the standard deviations changed, okay? And you can do this on your own if you want to. If you didn't see a change, put the correlation back at 1 and then change it to 0.5, and you'll see all the standard deviations change. The expected returns did not change. Expected return is not a function of correlation. Changes in correlation do not change expected returns, but they do change the standard deviation. And what you notice was that the standard deviations all got lower, except when we put all our money in X or all my money in Y, because now we get an advantage of diversification when I got some money in X and some money in Y. See, we lower our standard deviation because you will recall that we've got these 4 cells in our weighted variance covariance matrix, and 2 of those cells were covariance cells, and the covariance between X and Y went down. So if 2 of those cells are now smaller, that means we're going to have a lower variance for the portfolio and a lower standard deviation for the portfolio. So if I have half my money in X and half of my money in Y, the standard deviation is now down to 7.4%. It was at what I think was 8.5%, something like that. Let's change this back to 1 for a second. Yes, when the correlation was 1, the standard deviation, when you have half your money in X and half your money in Y, was 8.5%. Change the correlation to 0.5, and it drops now down to 7.4%. But it hasn't changed the expected return. Expected return is still 15%. So here is going to be half my money in X and half of my money in Y. It's going to be right there where I'm pointing now, okay? Now, what happens if the correlation is even lower between X and Y? Suppose the correlation is 0, okay? And by the way, 0 is not a magical number in terms of correlation. It just means they don't tend to move up and down together. They don't tend to move up and down opposite each other. It's just totally random in this case. So we put a 0 in there, we hit enter, and again, we got more of a bend in our hyperbola, because our standard deviations have again gone down. So what we're finding is that this is wonderful for risk-averse investors who don't like standard deviation. You get lower standard deviations when the correlation between these two assets is lower. And it seems that the lower the correlation goes, the lower will be the standard deviations. How about if the correlation is negative 0.5? Okay, lower it even more. Now we get, it's still a hyperbola, but it's got even more of a bend to it. And now if you put half your money in X, half of your money in Y, the expected return is still 15%, but the standard deviation is all the way down at 4.44%. And that's going to be right here with an expected return of 15%. Now, there's a very important point, okay, on this opportunity set. And it's going to be the one that is as far to the left as possible. And it looks like it's right around here. We call that the minimum variance portfolio, oftentimes just abbreviated as the MVP. MVP, I know in football stands for most valuable player, okay, or any sport does. But here it stands for the minimum variance portfolio. And it's where you have the smallest variance, which is also the smallest standard deviation on this hyperbola there, okay? So that's going to, just visually, it's going to be right about there. Now, we could look here and see what has the smallest standard deviation, and it looks like it's right about here at the 60-40, but remember, it might be 62% or 59% or something like that, so we haven't necessarily found it exactly. We could use Solver to find it exactly, but we're not going to do that right now. Okay, so we're going to bring down the correlation as far as it'll go. How far will it go? It'll go down to -1. At a correlation of -1, X and Y are moving exactly, perfectly opposite each other all the time. You'll never find that with two naturally occurring assets, but again, you can create derivative assets that do have correlations of -1. So it's definitely applicable. So we put in the -1, hit enter. And now what you'll notice is we no longer have a hyperbola. The hyperbola is stretched so far to the end, it became two straight lines. And this is highly significant because those lines intersect on the y-axis. And at the y-axis, we have a standard deviation of 0. Now, I kind of planned this out in advance, so I knew where this would be. When you have 58.82% of your money in X, 41.18% of your money in Y, you have an expected return of 14.12% and a standard deviation of 0. Very significant. When you have two assets that move exactly, perfectly opposite each other, if you put the correct weightings on them, okay, it's not just any weightings, but the correct weightings on them, which sometimes you have to use calculus to be able to figure out, or solver. But when you get the correct weightings on them, you can create a risk-free portfolio. You can always create a risk-free portfolio if you have two assets that move exactly opposite each other. We did an example of that in one of our earlier videos when we talked about the house that was worth $100,000, and we bought a homeowner's insurance policy on it. And the homeowner's insurance policy was worth nothing while that house was still standing. But if the house burned down, all of a sudden the homeowner's insurance policy was worth $100,000. It paid off. So they moved exactly opposite each other, the house and the homeowner's insurance policy. So if you own them both as a portfolio, now you have a zero risk portfolio where either the house is worth $100,000 or the insurance policy is worth $100,000. Okay. If the house doesn't burn down, it's worth $100,000. If it does burn down, the insurance policy is worth $100,000, so that you have zero risk. You're going to have $100,000 each way. The insurance policy was the derivative asset. Its value is derived from the house. It was specifically created to have a correlation of -1 with the house. And that's the concept behind risk management. Now, this is not a risk management course, but when you do take risk management courses, I want you to remember, okay, that the way you create risk, the way you do risk management is you need to create a derivative asset that is perfectly negatively correlated with the asset that you want to protect. In this case, the house is what you want to protect, and the homeowner's insurance policy is perfectly negatively correlated with that. And in this example, we've got X and Y are perfectly negatively correlated. So if you put them together in these percentages, you can get a portfolio that has a standard deviation of 0. Now, if you follow through on the notes, and the notes are for this is titled Optimal Risky Portfolios, you will get to see some of the math behind this. Specifically, why do we have 2 straight lines here? And when the correlation is 1, we have 1 straight line. You know, some of you who are a little bit more math oriented might find that interesting. I'm not holding you responsible for the math on that, but I think you might indeed find that interesting. But what I do want you to be able to see on this is that when we change the correlations, it changes the shape of the hyperbola. In fact, it's not a hyperbola when the correlation is 1 or -1. It's a correlation. It's a hyperbola whenever the correlation is less than 1 but higher than -1. And I want you to notice, so it's not changing expected returns, but it is changing standard deviations. In our next session, what we're going to do is we're going to set the correlation between them at 0.1, and we're just going to say, okay, the correlation is 0.1. We're just going to kind of hold it there. So we're going to have this hyperbola that looks like this, and we're going to have these values, and then we're going to reintroduce the risk-free asset and start thinking about combining the risk-free asset with X and the risk-free asset with Y. But we will start out with this situation with this particular X and this particular Y, and then with them having a correlation of 0.1.